Right now, while most people are relaxing, scrolling, or getting ready for bed, money is quietly shifting hands in global markets, and the people paying attention are positioning themselves before the rest of the country even wakes up. By the time this hits your newsfeed tomorrow, the move will already be done, the price will have adjusted, and most people will once again feel like they're chasing instead of leading. This isn't hype, it's not a wild prediction, and it's definitely not fear tactics. It's a live situation unfolding overseas that could directly impact the value of the cash sitting in your bank account. In this video, I'm going to break down exactly what's happening, why it matters to you, and what you can do before the opportunity window closes. Stay with me, because getting ahead starts with knowing before everyone else does. If you're new here and this is the first time you're watching, do yourself a favor right now. Hit that subscribe button and turn on your notifications. Because the kind of content I bring to this channel, real-time macro analysis, overnight market intelligence, geopolitical context that actually connects to your financial life, it doesn't come in neat packages during business hours. It comes when the moment demands it. And tonight, the moment is demanding it. So let me set the stage. The New York Stock Exchange closed hours ago. CNBC signed off. Your brokerage app is showing you end-of-day prices that are already stale. Your financial advisor is probably asleep. But on the other side of the world, in Singapore, Hong Kong, Tokyo, and Shanghai, the trading day is just getting started. And what those institutional desks are doing right now, in the opening stretch of the Asian session, is one of the most telling signals I've watched in a year and a half of tracking overnight markets. They are buying. Not slowly, not cautiously. They are moving into crude oil futures and physical silver with a speed and a volume that looks nothing like routine overnight positioning. This is not regular flow. This is not gentle accumulation from portfolio managers doing routine rebalancing. This is urgency. This is smart institutional money getting positioned ahead of a specific event that lands in the morning hours, European time, and when it does, it may completely reshape the energy and commodity landscape for weeks to come. The event is not some obscure economic data release. It is not a Fed minutes transcript or a jobs report. It is diplomacy. High-stakes nuclear diplomacy between the United States and Iran, taking place tomorrow in Geneva, Switzerland. And Asian institutional money is not buying oil and silver because they think those talks are going to go well. They are buying because they believe, with high enough probability to back it with real capital, that those talks are going to fall apart. And when they fall apart, the resulting geopolitical shockwave runs straight through a narrow strip of water in the Middle East called the Strait of Hormuz. And from there, it reverberates into every energy-dependent economy on the planet, including this one, including yours. Now, I want to take you through this step by step because I think it's important that you understand not just what is happening, but why it matters to you specifically. Not to traders in Singapore, not to hedge fund managers in London. To you, sitting in the United States, probably somewhere in the 45 to 55 age range, maybe older, thinking about the next 10 years of your financial life, wondering whether the assets you've built up over decades are actually going to hold their value, or whether inflation, policy mistakes, and geopolitical instability are going to quietly hollow them out before you even realize what happened. The background here is important. Iran's nuclear program has been a source of tension between Tehran and Washington for years. There was a multilateral agreement in 2015 designed to cap Iran's uranium enrichment in exchange for sanctions relief. The United States walked away from that deal in 2018. Subsequent efforts to revive a negotiated framework stalled repeatedly. Then, in late 2025, after Iran exceeded enrichment limits that were considered a hard red line, the current administration reimposed maximum pressure sanctions. That's what brought both sides back to Geneva. Two governments sitting across from each other with fundamentally incompatible demands, surrounded by an atmosphere thick with military posturing, watched closely by every sovereign wealth fund and institutional desk in Asia. And here's what those Asian institutions are reading into the situation. The United States currently has two carrier strike groups positioned in and around the Persian Gulf. The USS Gerald Ford and the USS Dwight Eisenhower are reportedly sitting within roughly 150 nautical miles of the Strait of Hormuz. Think about what that means. You don't deploy two carrier strike groups to that region and park them that close to a choke point if you genuinely expect 2 days of productive dialogue to resolve a decades-old standoff. That level of military posture is not a confidence signal. It's a pressure signal. It tells the other side and every observer that escalation is being prepared for, not just negotiation. Asian institutional money, which tracks military satellite data, shipping lane intelligence, and geopolitical positioning, the same way you might track a stock chart, is reading that posture and concluding that the probability of a diplomatic breakdown is high enough to justify going massively long on the two commodities that benefit most directly from a Hormuz crisis: Those two assets are crude oil and physical silver. Let me explain exactly why those two assets are connected in a way that most retail investors never think about, because this is the mechanical core of what Asia is running tonight. The Strait of Hormuz is approximately 21 miles wide at its narrowest point. That narrow channel carries roughly 20 to 21 million barrels of crude oil and petroleum products every single day, about 1 in every 5 barrels of oil traded globally. If Iran threatens that waterway, whether through actual military action, through naval exercises designed to disrupt tanker traffic, or even through credible rhetoric backed by observable troop repositioning, the global oil market does not inch upward. It gaps. It can jump 30, 40, 50% or more in a matter of hours because there is no alternative. You cannot reroute 21 million barrels per day around the Arabian Peninsula on short notice. The pipeline infrastructure doesn't exist at that scale. The storage capacity can't buffer a sudden loss of that supply. So the moment the strait becomes a real risk, oil reprices fast. Now here's where silver enters the picture, and this is the part I really want you to pay attention to. Mining silver is extraordinarily energy intensive. To pull a single ounce of silver from the ground, you need diesel for excavation and haul trucks, electricity for crushing and milling operations, natural gas for smelting, and petroleum-derived chemical reagents for the flotation process that separates silver from the lead and zinc it's typically found with. All of that cost is tied directly or indirectly to the price of oil. Right now, with WTI crude oil trading in the low to mid-70s, the all-in sustaining cost for an average primary silver miner runs somewhere around $21 to $24 per ounce. That's the baseline when energy is reasonably priced. But if oil spikes hard, if it gaps from the low 70s to $110 per barrel the way it did in early March of 2022 when Russia entered Ukraine, the energy component of mining costs can effectively double. Suddenly, your all-in sustaining cost isn't $22. It's pushing toward $40. And if oil keeps climbing, mining costs can approach $50, $60, even $70 per ounce at the high end of the production curve. With silver currently trading in the low 80s, there's still margin at $40 mining costs. But here's what the algorithms are focused on. They're not running a simple margin calculation. They're running a supply destruction model. Because when mining costs spike fast enough and high enough, mines don't just squeeze margins. Some of them curtail operations. Some invoke force majeure. Some make the economic calculation that running at current costs no longer makes sense and reduce output. And the moment supply starts coming offline, you create a feedback loop. Oil goes up, mining cost goes up, supply gets threatened, silver price goes up in response, speculative buying piles on, price goes higher, mining economics get worse, more supply comes offline. That spiral can carry silver from the low 80s toward triple digits in a compressed time frame, well before the physical supply disruption fully materializes. That is the mechanical logic of the trade Asia is running tonight. And the overnight data supports what I'm describing. WTI crude futures have moved up roughly 2 to 3% since the Asian Open, in under an hour of trading. On normal overnight volume, that kind of move would be remarkable. On the volume flowing through these contracts tonight, it's extraordinary. This is not retail flow. This is institutional urgency. And over in Shanghai, the premium that Chinese buyers are paying for physical silver above London spot has expanded to a level that hasn't been seen since a period of banking stress in 2025. A large Shanghai premium means buyers are willing to pay above market to get metal delivered into their vaults tonight, rather than waiting for tomorrow's London pricing. That is a direct bet that tomorrow's price will be materially higher than tonight's, which is a direct bet that Geneva is going to produce negative headlines. Drop a comment below right now and tell me, are you currently holding any physical commodities as part of your portfolio? Not ETFs, not paper futures. Physical. Gold, silver, anything energy related. I genuinely want to know where people in this community stand, because it helps me understand what kind of analysis is most useful to you. And while you're down there, if this is adding value to your thinking tonight, hit the like button. It matters more than you know for getting this content in front of people who need it. Let me add another layer to tonight's setup, because the Geneva talks and the Hormuz risk are the immediate trigger, but they're landing on top of a macro foundation that was already primed for a significant commodity move. That layer is tariffs. Just in the past couple of days, the current administration announced a 15% baseline tariff on imported goods from countries not covered under the USMCA trade agreement, effective March 1st, only a few days away. Silver is a physical metal. It gets traded internationally. A significant portion of the silver that ends up in U.S. industrial supply chains comes from mines and processors in non-USMCA countries. If you're a U.S. industrial buyer who needs to source silver for your production line, whether you're making solar panels, EV components, electronics, or any of the dozens of applications that require the metal, you're suddenly looking at a cost structure that changes materially starting Monday. You pull forward your purchases, you try to lock in supply before the tariff kicks in at full force. When multiple buyers do that simultaneously, you get a demand spike hitting right when the Hormuz geopolitical risk is already squeezing the energy-driven mining cost side of the equation. That's a two-sided squeeze. Supply gets more expensive to produce. Demand gets more urgent. That combination creates the kind of non-linear price move that catches people off guard. Here's what makes tonight's setup feel more extreme than other geopolitical flare-ups I've tracked. The system has fewer shock absorbers than it used to. Central banks have less room to cut rates aggressively to offset economic damage. U.S. debt is at levels that constrain policy flexibility. COMEX silver inventories, the registered stockpiles of physical silver sitting in exchange vaults available for delivery, have been drawn down significantly from their 2021 peaks. Less inventory means less buffer. When price spikes, the ability to cover demand with existing stockpiles is more limited, so price has to do more of the work of clearing the market, meaning bigger moves are required to bring supply and demand back into balance. Asian institutional money understands all of this. They are not buying oil and silver tonight because it's a cute short-term trade. They are buying because the risk-reward calculation, when you stack the Geneva trigger on top of tariff pressure, on top of tight inventories, on top of the energy-intensive mining cost structure, points clearly toward higher prices in both assets. Let me now give you the historical context, because this pattern has repeated every time the Middle East has produced a serious oil shock, an understanding that history helps you recognize what you're looking at when you see it in real time. October 1973, the Yom Kippur War. Egypt and Syria launch a coordinated attack on Israel. The United States resupplies Israel. Arab OPEC members respond with an oil embargo. Oil prices move from around $3 per barrel to $12 by early 1974. Silver runs from around $2.50 to nearly $7 within months. Same mechanism. The energy shock raises mining costs, supply tightens, hard asset demand spikes as confidence and paper wobbles. 1979. The Iranian Revolution topples the Shah. Iran's oil output collapses. Oil spikes. Silver goes parabolic into 1980, and one of the most extreme precious metals moves in modern financial history, driven by Middle East oil supply disruption combined with aggressive monetary expansion in the United States and a deteriorating confidence environment around dollar stability. 1990, Iraq invades Kuwait. Oil spikes immediately. Silver lifts alongside it, though the move is more contained because the coalition response resolves the military situation relatively quickly. But the pattern still showed up. March 2022, Russia enters Ukraine. A major commodity-producing nation is suddenly at war in Europe. Oil spikes hard and fast. Silver rises in the initial shock. The move happened in a matter of weeks, not months. What's structurally different about tonight's setup compared to all of those historical episodes is the combination I mentioned. Less Fed flexibility, higher government debt, thinner COMEX inventories, and now a new layer of de-dollarization pressure from the BRICS bloc that adds long-term structural support for hard asset demand that didn't exist to the same degree in any of those previous cycles. When shocks arrive now, the system has fewer cushions to absorb them, which means the price responses can be sharper than historical averages would suggest. Let me add one more structural layer here, because there's a bigger story operating underneath the immediate Hormuz headline risk that is deeply relevant to how you should be thinking about hard assets, not just over the next several days, but over the next several years. And that is the BRICS dimension of global monetary realignment. BRICS, which stands for Brazil, Russia, India, China, and South Africa, plus a growing list of newer member nations, now represents an enormous share of the global economy when measured by purchasing power parity and total population. And over the past several years, this bloc has been quietly, and increasingly not so quietly, building the financial infrastructure required to conduct international trade without routing transactions through the US dollar system. They are developing bilateral currency settlement mechanisms. They are building alternative payment networks. They are testing energy pricing in currencies other than the dollar. This process is called de-dollarization, and it matters enormously for the structural demand for US Treasury debt. Here is why that connects directly to silver. The global dominance of the US dollar as the world's reserve currency has, for decades, created structural demand for dollar-denominated assets. Countries and institutions that hold dollars for international trade need to park those dollars somewhere, and US Treasuries have historically been the instrument of choice. That structural demand has allowed the United States to borrow at lower interest rates than it otherwise could, and it has provided a baseline support for the dollar that exists outside of pure economic fundamentals. As that structural demand erodes, as BRICS nations gradually reduce their dollar holdings and transact more in their own currencies, the dollar loses a portion of its structural floor. And when the dollar weakens, when inflation risks rise, when the long-term viability of the fiat system itself comes under scrutiny, The capital that used to flow into government bonds starts looking for alternatives. And historically, a meaningful share of that capital flows into gold and silver. The gold to silver ratio right now sits around 37-1. That means it takes roughly 37 ounces of silver to buy 1 ounce of gold at current prices. Historically, that ratio has swung widely in both directions. It compressed sharply in 1980. It compressed again briefly in 2011. And in environments where silver gets both industrial and monetary demand hitting simultaneously, the ratio tends to compress, meaning silver outperforms gold on a percentage basis. That is the mathematical overlay that Asian institutional money is considering tonight. Not just the Hormuz trade in isolation, not just the tariff trade in isolation. They are looking at the complete mosaic: geopolitical trigger, energy mechanism, tariff pressure, structural monetary backdrop, tight inventories, BRICS realignment, military posturing, and the mosaic points towards silver being asymmetrically positioned relative to its current price. Now, intellectual honesty matters here. What if I'm wrong? What if Geneva produces a positive outcome? What if the talks extend, both sides make concessions, and oil and silver don't gap? In that scenario, the geopolitical premium bleeds out. WTI pulls back. Silver, which moved up in anticipation, gives back some gains. You might see spot silver retreat from the low 80s toward the high 70s. That's real money given back by traders who positioned for breakdown and got a breakthrough instead. But here's the thing. Silver at 77 is still supported by structural demand that exists completely independently of this geopolitical trigger. The industrial demand from solar manufacturing, electric vehicles, defense electronics, and 5G infrastructure isn't going away. The inventory drawdowns don't reverse overnight. The tariff pressure, effective March 1st, doesn't disappear because Geneva went well. And the broader de-dollarization story, the long-term structural question about whether the dollar retains its reserve currency dominance through the rest of this decade, doesn't resolve because of a 2-day meeting in Switzerland. So the calm scenario doesn't reverse the medium-term silver trend. It just removes the immediate spike catalyst and leaves you with a slower grinding move higher over the following months, instead of a violent one over the following days. But I'm not leaning on the calm scenario. When I look at the military posture, when I look at the naval assets deployed in proximity to the strait, when I watch what Asian institutions are doing with their capital tonight, the weight of evidence points toward breakdown being the more probable outcome. And professional risk management is about positioning for the most probable outcome while acknowledging the downside case honestly. Share this video right now with someone in your life who needs to be paying attention to this. A spouse, a sibling, a friend who's been asking whether they should be moving some savings into hard assets. This is the kind of real-time intelligence that the major financial media networks won't give you until after the move has already happened. They'll wait until after the Reuters headline hits, then bring on someone from a big bank to explain it all in hindsight with great confidence. And by then, the entry that made sense at midnight won't exist anymore. The financial media in this country operates on a delay, by design to some extent, because the institutions that advertise on those platforms benefit when retail investors are always a step behind. CNBC, Bloomberg, the financial press generally. They'll cover this story tomorrow afternoon after the move has happened. The explanation will be accurate, but you won't be able to act on it. That gap between when institutional money moves and when the financial media explains, it is the gap that this channel exists to close, at least in part, for the people who are paying attention. Let me close with the framing that I think matters most for anyone in this country trying to navigate the next decade of their financial life. The system is under stress in ways that don't show up clearly in any single headline or data point. U.S. debt is at historically extreme levels. The Federal Reserve is caught between an inflation problem and a financial system that can't easily handle significantly higher rates for extended periods. The BRICS realignment is slowly but measurably eroding the structural demand for dollar-denominated assets that has supported American borrowing costs for generations. And now, into that fragile backdrop, you have a geopolitical flashpoint of genuine magnitude sitting in Geneva tomorrow morning, with 2 carrier strike groups parked near the world's most important energy choke point, and Asian institutional money voting with its capital that diplomacy is going to fail. That's the world we're navigating, not a normal market environment, not a world where a standard passive portfolio handles everything on autopilot, a world where geopolitical triggers can produce commodity shocks that arrive faster than traditional financial advice can respond to them, a world where understanding the real-time flow of institutional money gives you a meaningful edge over reacting to yesterday's headlines, a world where physical assets, energy, metals, commodities that serve both industrial and monetary functions deserve serious consideration in any portfolio that's trying to preserve purchasing power through the rest of this decade. The Asian session is running right now. The overnight markets are pricing in their view of tomorrow. By the time the sun comes up on the East Coast, a significant portion of this trade may already be established. The question is always the same. Are you going to be ahead of the headline or behind it? Pull up your trading platform or a free charting service right now. Look at WTI crude oil futures. Look at the Asian session volume and where prices relative to the New York close today. Then look at silver. Look at where it's trading. Then come back to the comments and tell me what you're seeing. Tell me if the data matches what I've described tonight. Because the whole point of this kind of analysis is to help you develop the framework to see these things for yourself, not just hear me describe them. I'll be right here, watching, updating, and walking you through this as it develops. Don't forget to like this video if the analysis has been valuable to you tonight. Share it with someone who needs this perspective. Drop your thoughts in the comments below, and stay subscribed to Element Axis, because this story is far from over, and the next 12 hours are going to tell us a great deal about where commodities and the broader macro environment are heading for the rest of 2026.